Today, I'd like to look at a question relating to company financial statements, particularly looking at the non-current assets or tangible assets. The question that we're going to look at is from the Cambridge paper, June 2016, paper 3.1. ACM plc provided the following information about its non-current assets. You can see that a number of balances have been given and some additional information. First, have a look and see what is required. You need to prepare the disposal of machinery account for the year ended 31 December 2015. So what I would suggest you do is just draw up your T account so that you're ready to put any information in there as you get it. You can at this stage also put in your dates because you will need those, and it will help you focus on exactly when you are doing this for. Right, now we've got that ready. Let's have a look at the rest. Don't worry over here. These are calculations that we will do later on. You won't necessarily know what you'll need to do when you're setting it up. So just setting up the T account on its own at this stage is fine. B says, prepare the non-current assets schedule, in other words, the note to the financial statements for inclusion in the published financial statements of the company for the year ended 31 December 2015 in accordance with international accounting standards as set out by the International Financial Reporting Standards. So over here, what I've done is I've set out a note. Now, the standards simply say that you need to have details of each of the items that you've got with a total. You need to show the beginning values, you need to show the end values, and you need to show the movements during the year. In actual fact, if you look at published financial statements, you'll see that they do a slightly different layout to the one that I've got over here, but I've decided to follow the layout that was given in the mark scheme for this question. That is quite simple. Basically, you've got your cost showing beginning, middle, end. You then show your depreciation at the beginning, what it changed in the middle, and at the end of the year. And then you use your cost and your depreciation together. Note that this is total depreciation to get your net book value or net carrying value at the beginning and the end. If you look at published financial statements, you'll see that sometimes what they do is they simply show it as the carrying value at the beginning, broken up into the cost and the accumulated depreciation. They then show all the movements during the year at carrying value. So in other words, obviously additions will be at cost, that is the carrying value, but your disposals will be shown at the net carrying value, as well your depreciation is obviously just depreciation amount. And then at the end, they show the carrying value at the end, broken up into cost and total depreciation. I'm just mentioning that so that if you do look at published statements and they look different, you don't get a fright. You do need to be able to look at different layouts and be able to understand what is going on. And the less scared you are and the more you try and make an effort to understand them, the better off you will be. Trying to learn this off by heart is really not that easy. So instead, make sure you understand what you are doing and what IAS requires. In other words, show your beginning values, your end values, and all the changes in between for cost, for depreciation, and your net book value. Then you're fine. Right, so I've laid out my table over here. Again, I've given myself some space for calculations at the bottom. We'll get to that just now. You won't know what calculations you need to do as yet. And then question C, explain why a business depreciates its non-current assets. In actual fact, you could actually answer that right now because it's simply a theory question, or you could come back later. Since we're looking at it now, let's quickly just go through it. There are really three main reasons why you would want to depreciate your non-current assets. The first is the fact that you realize your non-current assets aren't going to retain their value forever. They are going to lose value over time. And so you don't want your non-current assets to be valued at the incorrect value on your financial statements. So we want to make sure that our non-current assets are not shown or are not overvalued in the statement of financial position. The next reason that is important is combined with that, because it's going to lose value. It's going to lose value over time. And remember that you want to match your expenses with your income. In other words, you want to match your costs with the income that you generate in that period. Okay, so the expenses for that particular asset need to be matched with the income that you generate in that period by that asset. And then the last thing is linked to that again, you don't want your profit to be overstated. If you don't depreciate your assets, it means that your profit is not actually a true reflection of the profit that you're making for that period. So those are really the main reasons that you're going to depreciate your assets and why we're going to do everything that we're going to do in the first part of this question. The second part of the question actually looks at some different information, and we're not going to look at that today. I just want to focus on this first exercise just so that we can focus on one particular area. We'll come back to the other one in a later exercise. Right, so now we've got our layout. Let's go back and look at the information. Now, although you might be inclined to go and do your disposal account first and then do this, I would suggest that you lay it all out in the beginning as we've just done, so that then when you get information, you can use it. Because over here, my beginning and end balances are going to be very useful to use in my tangible assets note. So what I'm going to do is I'm going to ignore my disposal because I don't have information on that yet, and I'm going to go straight to my disposal, to my tangible assets note, and I'm going to put these balances in. Here you can see my property. This is now my accumulated depreciation at the beginning. My property had a accumulated depreciation at the beginning of 17,000. So I'm going to pop that in over there in the middle of nowhere, but that's fine. My plant and machinery had a balance of 210,000, and my delivery vans had only depreciated by 10,000. That's the total depreciation over the entire life. So you've probably had your plant and machinery for a number of years, you can see, because there's a lot of depreciation shown over here. I then look at my costs. I've got my cost at the beginning. So my property I'm going to show as 200,000, my plant and machinery 258,000, and my delivery vans 23,000. At this stage, you can also fill in your totals, or you can come back and do them later. Personally, I prefer to do them all at the end so that I'm not getting distracted. Right, I can then now put in my cost at the end of the year, on the 31st of December at the end, 200,000 for property. So you can see, therefore, immediately that there were no additions, there were no disposals. My plant and machinery has got a 310,000 balance, so immediately I can see that something is missing here. Don't worry, we'll come back to that just now as we find more information. The delivery van's value at the end is 23,000. Again, we can see there were no disposals and no acquisitions. So, if we have a look now at the additional information that is given, half of the value of the property relates to land. Now, that's quite important. Remember that land does not depreciate. If anything, it actually gains value, but we won't worry about that. The point is, of this 200,000, half of it, or 100,000, relates to land, and the other 100,000 relates to property. So if we're going to depreciate the actual land and buildings, we're going to say our 200,000 divided by 2 to get the half, and then we will work out the percentage as it says here. Property is depreciated at the rate of 1% per annum using the straight line method. In other words, that it's the same amount year on year. In other words, you just take that percentage of cost. So I'm going to work out 1% of the 100,000 that relates to my actual land and buildings, and that is how I'm going to get a depreciation charge of 1,000 Rand or $1,000 or whatever currency you're using for this particular period. Number 2, plant and machinery is depreciated at the rate of 10% per annum using the straight line method. Okay, so plant and machinery, you can make a note here, 10% if you want on cost. Now, the reason I'm doing that is because they haven't actually given me enough other information to carry on yet. You'll see in a minute. A full year's depreciation is provided in the year of purchase and none in the year of disposal. Now, this isn't particularly accurate, but it certainly does make it a little bit easier for you when you are working this out. Because what it means is that when you bought the item, if you bought it in the middle of the year, You just do a full year's depreciation, even if you only had it for half a year. And in the year of the sale, you don't worry about depreciation at all. So it does simplify matters. On the 1st of June 2015, a machine that was bought on the 10th of July was sold for $17,800. This resulted in a profit on disposal of $13,000. Now, immediately you can see I haven't got enough information to work out my depreciation as yet, but for that disposal. The only thing I can do is, because it says to me that I don't worry about depreciation on the sold item in the year of disposal, I can look at my plant and machinery cost at the end. And I can see that the cost at the end was $310,000. So my charge for the year is $31,000. But this eliminated on disposals, I will have to come back to in a minute. So let's go up to my disposal account. We do know that it was sold for $7,800. So immediately I can show it might be bank, it could be, if you sold it on credit, it could be debtors, but we'll just assume that it's cash for now to keep things simple, and we will show 17,800 as my selling price over there. I can pop that in immediately. It then tells me that this resulted in a profit on this disposal of 13,000. That's quite a large profit, and that means that this price here was quite a lot more than what it was actually worth. So your profit would go in on this side, because it means that your total received and your accumulated depreciation were worth more than your cost originally and this profit that you are making. So your profit is shown over here. In fact, you'd probably call it income statement, because you're doing a nice general ledger account, and that's where it would end up going. But if you want to for yourself, you can keep in mind that that is your profit of 13,000. And what that means is you can now work out that the carrying value when it was sold was the difference between those two. 1,700 minus 13,000 equals 4,800. That was obviously the carrying value. So what you can do now is you can work out that if you had the vehicle or the machinery, sorry, for a period of time, look at when it was. It was bought in 2007 and it was sold in 2015. So if it was bought in 2007, sold in 2015, that means that you had the machinery for 8 years. If it's now worth 4,800 Rand and you're depreciating it by 10% per annum for 8 years, that means that you can actually work out, if you look at this, your carrying value of 4,800 is your cost minus 80% over here. So your cost is actually going to be 4,800 divided by 20%. In other words, what is left over. If you've depreciated it by 80%, it means that this carrying value is 20% of the cost. So if I say 4,800 carrying value divided by that 20% that it represents, that means that I can work out that my original cost must have been $24,000 at the beginning. My total depreciation for the entire period, you can then work out either as 24,000 times 10% times 8 years, or times 80%, which is going to give you your amount of 19,200, or you could do it the other way around and say 4,800 carrying value, and say that that is 20% of the total, but my, sorry, and I can actually work that out, sorry, and say times 80, sorry, times 20%, no, sorry, I'm getting myself tied up in knots here, let's not even go there. It's easiest to work it out like this, okay? 24,000, 19,200. The other way you can do it is you can say your 24,000 minus the 19,200, which you've worked out, which was already given to you. Sorry, minus the 4,200. I really am tying myself in knots. I'm sorry. Okay, so 24,000 minus the 4,800 that was given to you here as the carrying value. If you take your cost minus your carrying value, that will give you your depreciation, total depreciation of 19,200. That's what I'm trying to show you. My apologies for the confusion. I do hope I haven't confused you too much, and you can easily see here how I'm getting 19,200 as the total depreciation over the entire life of this machinery for the past 8 years. Once I've got that, I can show it here as my total depreciation or provision for depreciation of machinery. And I'm going to put it in as 19,200. At the same time, and this is where it's quite important to be doing things at the same time, I want to take that out. I want to eliminate it from my provision account, which is why you can see I've actually, by putting it into my disposal account, I am making it leave the provision account. So over here in my tangible assets note, I need to eliminate that depreciation over here. So the elimination of the depreciation on the disposals is going to be used as part of this calculation. Once I've got all of that information, my disposals account then can then actually get balanced or closed off, because you should know that there should be nothing left in this account. We are simply creating it to work things out for ourselves. And you can see that you now have totals of 37,000, which means you can work backwards to find out what your machinery cost was, or as we did over here, you can put in your 24,000. So you can see there's a couple of ways that you can actually work out the 24,000 and the 19,200. It doesn't really matter which way you go. I've shown you a lot more calculation here than you actually need to do, because your T account here will help you work out whatever you need as a missing figure. This first part over here is the important part that will help you get started. And then this little calculation over here is important to be able to work out what you need to from there. The rest, whichever path you take, is up to you. Right. Now that we've got that important information, we can also show the plant and machinery with a disposal over here of 24,000 Rand. Right, now we've used everything that we can from information number 2. Let's go on and do information number 3. The delivery vans are depreciated at the rate of 25% per annum on the reducing balance basis. So if we go now to our notes, delivery vans are 25% on reducing balanced, or I like to say on carrying value. You can say it doesn't matter what abbreviation you use, as long as you understand what you're doing. Sometimes I actually even like to write it up over here instead. So that I know that that is my depreciation policy. You do what works best for you. Now, the delivery vans had a cost of 23,000 at the beginning. And then from there, you need to subtract the total depreciation at the beginning. In other words, in this case, 10,000 to get my carrying value at that point. In other words, my total delivery vehicles were worth 13,000 Rand. And now I want to take off 25% of that, and that will then give me 3,250 as the depreciation charge for the year, which I will then pop in here in my delivery vans column as the depreciation charge for the year. Right, I have now used all that information that I can, but there's still something else that I need to do. Do you remember I said to you there's a missing figure over here that we are going to have to work out? Because it was not given to us. So I'm going to put it in bold when we put it in, just that you can see. And basically the easiest way to do this is to recreate a T account for your plant and machinery. So over here I know that my cost at the beginning was 258, so I can say balance brought down was 258,000. I know that my plant and machinery disposals, the cost was 24,000. So I'm going to put my 24,000 on the credit side because I have disposed of that. I know that my balance, sorry, I'm just going to write here disposals, otherwise you're not going to know what I'm trying to do. 1,000, right. And at the end, I can see I've got a balance of 310,000, where I'm going to say on this side here, balance brought down is 310,000. If I've got a balance brought down here, remember that I would have totals. Now I've just taken a shortcut and I've put in a nice solid line over here because I don't want to waste time showing the totals. Of course, if you find it easier to show the totals, by all means go ahead and do so. Sometimes I don't even put this balance carry down in that I'm busy doing here, but I'm just showing you so that you understand what my thinking is. But very often I actually just leave that piece out as well. Then I can see if I add my disposals and my end balance, I subtract my balance at the beginning, that is then going to tell me what my additions must have been, and I work that out as the missing figure. And by doing this, I can then see that my additions must have actually been 76,000. Basically what I did was I said 24,000 plus the 310,000 to get what would have been the total over here, minus the 258,000 balance at the beginning, gives me the 76,000, which I can then put here as my missing figure. And then everything works out. At this point, obviously, what you will need to do is you will need to go and do the rest of your adding and subtracting. All these totals and balances over here would need to be done. I will just start with you so that you can see how you can do it, but I won't waste your time doing all of them. You can see here, if you say 17,000 plus 1,000 for your property, that means you've got 18,000 at the end of the period. If you then show your net book value at the beginning of the period, you would have had 200,000 minus the depreciation of 17,000 at the beginning. So that would have been your 183,000. And at the end of the period, you're going to say your 200,000 minus 18, which gives you your 182,000. Sorry about my messages popping up there. Please ignore them. So this is showing you basically your totals. Your 200,000 minus 18 gives you your end book value. But notice that you do also need to show the beginning, and that is simply a reconciliation of these two numbers here. The beginning of the year cost and the beginning of the year depreciation. That is how you work it out. You'll use exactly the same methodology for the others, and that shows you how you get your totals. I do hope that that will make it easier for you to see. If you want to, you can see there are your answers that you can check yourself with all your totals. Thank you very much for joining me today. Keep well. Bye.